Hi, Carol, Thatcher. Thanks for coming in. This is our fourth step of the financial planning process. The first one being where you guys first came into the office and we had interviewed each other. The second one being the fact finder process where we sat down and collected a lot of the facts that we were going to use for the financial plan, comprehensive financial plan. The third step was when I gave you guys a call a couple weeks ago. I was missing a couple items there. I do appreciate you taking that call. The fourth one being here we are on the fourth step, and this is the part where we list the recommendations of the financial plan, and as well as the more or less the executive summary of the items. Before we step in, I always like to put on the board here, and it's there on number one. What questions that you guys have, you Thatcher, you Carol, or anything that we can you would like to add to the agenda? We do have a long list here, but anything that you would like to add? No. Okay. Well, if what I've got here is a 20-minute appointment. Whatever amount that we don't get into, we'll go ahead and book the next meeting. So we'll continue the talk if we don't get through all of it today. Just talk about a little bit of the process for today. We'll go through the recommendations here, but at the end we'll give a blunt conclusion of what your assets looked like before. Excuse me, what your retirement plan looked before these recommendations, and what they look like now, or at least after we make the recommendations that they're implemented over the next couple of years. The first recommendation is the estate planning. You guys don't have an estate plan, and we recommend the 6 items of an estate plan. Now, we're not attorneys, but we do hold our clients' feet to the fire, which many of our clients think it's very important to do that. They actually like that we hold their feet to the fire. But the 6 items of an estate plan for you guys would be the will, the healthcare proxy, the living will, the power of attorney, the updating the beneficiaries, and the special needs trust. Now, these items are listed in the financial plan here, but we strongly recommend, we have your goals listed, and we'll go over them. But before we even reach those goals and getting those goals situated with recommendations, to set up an estate plan. Recommendation number 1 is to set that up. Because if you do not have that, and you work on all these other items, all these other recommendations to make the perfect plan, and then something tragic like both pass away in a car wreck or something like that, then the whole plan goes out the window. And if you didn't have that estate plan built up in the first place, then you're much worse position. And I should say that your beneficiary is in a much worse position. So those 6 items are listed here in importance of why we recommend them, what the costs are associated with them. But we're going to go to recommendation number 2. Do you have any questions on the first one? Okay. So the second recommendation is the tax reduction strategies. There's 3 items there, the tax reduction strategies that we have, and these are going to a dollar saved is a dollar earned. Every dollar you save on taxes on smart strategies, it means that your retirement plan is going to be that much better. So that's where these recommendations come into play to make your retirement look better. The first tax reduction strategy is to sell the joint account. Now, recommendation number 3 is to reallocate your portfolios. Thatcher, your 401k, Carol, your Quadra, but also the joint account as well. You have a couple of holdings there that are not in line with, frankly, either of your risk characteristics. So we'd recommend an allocation to better suit those needs, as well as that Apple as well. You have one individual stock, and it has appreciated. That's good, but you could also see a depreciating individual stocks is a major risk to your retirement. It is not diversified. Now, reallocating the joint account has a tax problem. It's because if you sell those holdings, there's going to be a sizable taxable event there. You have to pay a large amount of capital gains taxes. So what we would recommend is to space it out over 2 years, this year and next year. You sell half of it now, and you sell half of it next year. Now, what we would also recommend on the tax strategies is Thatcher, you increase your 401k contribution by $15,000 a year. Now, you're thinking, oh, I gotta live, I gotta eat food. Yeah, we understand. So, but what we recommend is reducing your salary, but increasing the money you take from your joint account. You take a monthly distribution out of your joint account, or every 2 weeks if you get paid every 2 weeks, and it replaces the income lost from reducing your 401k contribution. Now you're asking, why would that be important? Well, you're going to reduce your ordinary income taxes over here, but you're going to increase your capital gains taxes over here. And it's going to be more of a wash on the tax side. And so we're going to reallocate the joint account, but by contributing more to your 401k and taking some out of your joint account, putting in your bank, there would be a fewer amount of taxes owed to the IRS. Again, dollar saved is dollar earned. The second tax reduction strategy is relating to Anne. Now you're paying $36,000 a year for Anne, and I didn't see on your tax return that you were itemizing those taxes. Itemizing those expenses, which you should be able to. Now we would recommend that we work with your CPA, Patrick Mahomes, to make sure that you are itemizing all that you can. Because if you were able to itemize all those $36,000 taxes, we estimate that's about $5,000 in taxes saved per year, and that's a very sizable amount earned over your lifetime. It's a sizable amount saved over your lifetime. And you put that $5,000 over the next 5, 10, 15, 20 years, that can mean retiring or not. To be honest, so we would work with your CPA, which we will set up after this meeting. We're going to set up that appointment to work with Patrick. The third strategy, I'm going to go and flip the page here to better represent what the third strategy is called: net unrealized appreciation. Now this, Patrick, this refers to you in your 401k. You have a net unrealized appreciation strategy, Thatcher, that you are able to do. Now what this strategy entails is, first you'd have to work for a company that you own the company stock, which you do, Home Depot, and that company stock would have to appreciate, for lack of a better word, wildly. It would have to appreciate greatly. When those two take place, you are able to, technically after the age of 55, in some cases 59 and a half, you were able to take that 401k and put it into an IRA, and then take the Home Depot stock out of the 401k and put it into a brokerage account. Excuse me. The IRA, 401k IRA, that's going to be your non-company stock. So that's going to be all the 401k that's not Home Depot stock, and that's a non-taxable event. Now, when you take the Home Depot out, what this is saying, the company stock, when you take it out and put it into that brokerage account, that what you guys have, that joint account, it's going to be something very similar. When you take it out and put it in a joint account, it's going to be taxable. Now, it's taxable only to the point of what you paid for the Home Depot. Now, that's what I mean when a stock has greatly appreciated. That means that tax basis is very low because it's a very appreciated stock. It's worth up here in value, but you paid down here for it. Now the difference is you pay ordinary income taxes down here, but when you sell the stock later in life, after you do this, step number 3 here, when you do this, you pay long-term capital gains taxes, which are always less taxes. And so that's the true benefit. This is a strong recommendation, and we run into it every couple times with Home Depot, Lockheed Martin, General Dynamics, a couple of those companies, Huntington, those companies that we have clients with. We've done this net unrealized appreciation a couple of times, and it has greatly helped clients save, just to be honest, tens of thousands of taxes because the stocks have appreciated so much. So this is a strong recommendation. I'm going to flip the page back so we can talk about number 3. So that was the tax reducing strategies. We're going to go to recommendation number 3, the reallocation of the accounts. Now, Carol, your Quadro account is actually too risky for what you've explained to us about how you like your investments to be allocated. Your investments are emerging markets and high yield, And so we would recommend a more diversified portfolio that suits what you're looking for uh, in your portfolio. You also have muni bonds as well. So getting rid of those muni bonds altogether, because muni bonds give a tax-free interest, which in a tax-deferred account like a Quadro or 401k, um, basically gives no benefit, because when you take money out of the 401k, it's not tax free anymore. It's all taxable, and so it has little benefit to you, that feature, that tax free benefit. And so we've recommended here in the financial plan that I've got here, we have four holdings that we've recommended here to replace all of your holdings. Thatcher, you're on the other side. You told us you like to be growth. You're looking for growth in your accounts. You don't mind higher risk investments, and we're seeing the opposite. You're not as growth or as risk non averse as you say you'd like to be, and so we recommend a particular holding called Personal Choice Retirement Asset, which is a Charles Schwab holding that you have an option in your 401k. So keep it in your 401k, your current 401k, and of course keeping the Home Depot stock in play, keeping that as is. Now, because usually we recommend you sell individual stocks to diversify, because we're not recommending you do that for Home Depot. We do recommend that you allow us to put a warning, not a stop loss, but a warning that an alert will come to us if that Home Depot stock starts to depreciate outside of the market. And why that's important, you may save thousands of taxes for this net unrealized appreciation, but if the stock decreases the same amount in stock value, then it's no longer worth it. So that's a stock that we would want to watch carefully before you retire. Recommendation number 4: Social Security and pension. We'll start with the Social Security. Thatcher, we recommend that you hold your Social Security until age 70. Now that's a couple years after you retire. The reason why we recommend that you hold it to age 70 is because from age 66 to age 70, that Social Security benefit would increase by 8% per year. So by the time you get to age 70, that Social Security has appreciated by about 30%. So that's a huge increase in a fixed cash flow bucket, Social Security, and so we strongly recommend that you do that. Carol, you mentioned, your pension statement said that you will not get a Social Security benefit based on the number of years that you would work, and you also mentioned the same thing. Now, I would find that odd that you would not get any Social Security benefit from any other jobs that you worked previously. So I would still recommend that you go to socialsecurity.gov. I've got it written here in the financial plan. You don't have to write that down, but go to socialsecurity.gov, see your statement, and if that number from your statement is more than $442 a month, then you could still get a Social Security benefit. It would still be advantageous to go ahead and take your Social Security at a certain age, between 62 and 70. But let's first determine if you do indeed, in fact, not have any Social Security benefit. Now, your pension, Carol, we do recommend, assuming you don't have a Social Security benefit, we would recommend that you go ahead and take 100% survivor option for your pension. Now, this is in a couple of years, so this may change, obviously, but what that means is if you pass away, your husband, Thatcher, would get 100% of that pension for the rest of his life. You get a lower amount on the pension because the company is insuring 2 people instead of just one, but the recommendation would be that Thatcher would then have enough cash flow to make sure that the goals are established. Recommendation number 5: reducing expenses of certain goals. You had 2 goals. We haven't listed them yet, but you had 2 of those goals. One of them being buying a new car every 4 years for each of you, and the second goal was to pay for Jenna's wedding. Now we would recommend that uh, we your goals are from strongest to least, or from most wanted to least wanted. Um, we've put those goals into place. The line item. We'll get into them what they are, but when you're looking at which goals are more important to you, it's a trade-off. And what we would recommend is that you buy a car not every 4 years, but every 8 years, and that would allow a what you're doing every 4 years is buying a piece of property, a car that depreciates wildly after every 4 years. In fact, every 4 years, a car would depreciate after you take it off a lot. It could depreciate up to 50%. And so it wouldn't be, excuse me, 25 to 30%. It wouldn't be advantageous for you to buy a $40,000 vehicle every 4 years. Imagine if you had done that to your 401k. If your 401k was depreciating that quickly, it would be very bad to your, lack of a better word, be very bad to your retirement plan. And so the longer you span that out to buy a new car, the better for you. Now we recommend to buy it every 8 years instead. And if you don't like that every 8 years, then we would actually recommend you lease a car because the depreciation would be too much on your. The depreciation would end up making sure that you could not retire at even at what we would recommend. And so this is a strong recommendation to either lease a car or buy the car every 8 years, with the latter being the best recommendation. With Jenna's wedding expense, I'm not sure how important this one is compared to leaving inheritance at the end, but from what we could tell, the inheritance was slightly more important. So when it pertains to paying for $50,000 versus say 15,000 during right before you start to retire, it's very important to minimize those types of expenses so you can meet your other goals into retirement, before and into retirement. Um, One of those goals being the inheritance, the $200,000 inheritance. Uh, much easier to obtain those types of goals when you can reduce those expenses, which is what we would recommend. Um, Recommendation number 6 is the selling of the property. Now, this one here is also a major recommendation, a large recommendation. Carol, you do have a property worth $300,000, and you had mentioned that you would like to hold on to that. It's a trade-off, as we said before. This is a trade-off. Your That property is holding you back from attaining your goals into retirement, and so we would recommend you sell it and use it to pay off the credit card expenses, what's left, one of the car loans, and then take 35,000 of it and put it into a New York 529 plan for Bregman. That's going to help you obtain those goals. That's not going to be all of it. We recommend you take the rest of it and reinvest it back into the capital markets. That joint account, have a balanced portfolio, a very diversified, balanced portfolio, and use it for your retirement. This is going to allow you to obtain your goals, not just for retirement, but in this case, Bregman's college and passing assets to as inheritance. Right, that gets us to recommendation number 8. That last one there. Thatcher, you would like to retire at 65. Carrie, you'd like to retire at 59. Even with all these recommendations, before these recommendations, we saw you guys running out of money quite quickly, retiring at 65 and 59, which is not a good thing. You have all these major expenses and lifestyle that you like to obtain. I'm assuming you want to keep the same lifestyle in retirement, but it was unobtainable. And after these recommendations, minus that last one, we want to try to get you to that age 90 and above to make sure assets last to that age. And with the retirement, we would recommend that you go a couple years longer than you first thought you were going to. Thatcher, we would recommend you go retire at 67 or 68. Carol, we would recommend you retire at 62. That is a couple of years longer than you both wanted to, but by doing so, it's a trade-off. that you're able to meet the goals that you guys have established to us are important to you. So we are at a time, it's 20 minutes. Let's go ahead and set up the next appointments. We're going to implement these recommendations. I've got the financial plan here. I'm going to go ahead and give it to you guys after I've signed it. Here it is here. And let's go ahead and set up the next appointment. Thanks very much.